Hi traders, Chris Weston here from Pepperstone, Head of Research. Hopefully everyone can hear me fine. Obviously last week we had a few technical issues. I'm hoping that they've resolved themselves quite nicely. We're going to go through all the things in the gold market today. We're going to have a quick look at the setups that are floating my world and some of the things that we've been talking to clients about last few days or so. But I think we go straight into the charts to set the scene. What you can see here is a Bloomberg chart. I've obviously cut the far left side out, but what we're looking at is the performance of gold in various currencies. You can see the purple one there is gold priced in Aussie dollars. The orange is gold priced in pounds. The yellow at the bottom is in yen. And again, we come back to our old friend where, you know, if you're going to go long gold, we tend to want to do it in the weakest currency and we tend to want to be short in the strongest currency. So what we do at Pepperstone is we offer these different currencies, XAU, AUD, for example, in purple. And you can see over the last 5 days, we did the last one of these on Thursday last week. We can see that gold in Aussie dollar terms is up 3.7%. So it's been a really good move. But what I really like about this and why I want to start with this chart was that we're seeing gold rally in all currency terms. So it's not just a currency effect. Gold over the last 5 days has rallied in all currencies. And that shows that there's been, you know, real momentum for gold in that scenario. The question is will Aussie dollar gold continue to be the place to be? So you can go to your MT4, MT5 CTrader platforms and have a look for XAUAUD. And effectively, you can see that has been the place that we're getting the best bang for your buck in those currency terms. I also just want to quickly, before we go into the charts, have a quick look at this one, because what we've done here is just look at the trading ranges that we've been seeing in gold. And I specifically looked at gold in US dollar terms, which of course is where we see about 90% of our gold flow. And gold actually in itself is our most actively traded product of any of the instruments that we offer to clients. And what I've done here is the logic I've used is looking at the daily high minus the daily low, and got that number and used that as divided that by the previous day's close to look at percentage ranges. Us as traders, of course, is we're looking at the full 24-hour move rather than look at things like realized volatility or implied volatility, which I like to look at. We want to have a look at that full day's range because that's what we're trading. We trade in that 24-hour period. Now, last week we saw obviously that explosive move on Monday, which we covered last Thursday as to why that happened. But now you can see this 5-day moving average just to sort of blend the performance of these down. You can see that the ranges that we're seeing in US dollar gold are starting to fall back a little bit. So are we going to see, you know, lower ranges, lower volatility, lower movement, and a kind of stealth move up or down over the coming 5 days? So that's something that I really like to look at when we're trading, whether we're trading a daily charts, 5 hour, 4 hour, whatever we're looking at. It's really about that volatility and movement that we're seeing, which is so important for traders. But you can see there that the volatility and the ranges are coming down a touch. Okay, let's have a look at the daily chart of gold in US dollar terms. I think this, we talked about this last week. We can see the candle here on the 12th of August. This is where we were. We were in this kind of no man's land really last week, and we were like, you know, well, if this breaks the upside, I think it's going to continue going. I think people go back, have a look at the video for yourself. But we were saying that we were kind of in this kind of hiatus where the gold price really needed to reveal itself, and it needed to compel and push us into a trade when we're in this kind of when the market's not really giving us too much. Sometimes having patience, in fact, most of the time having patience and letting the position push you and say, Chris, you've got to trade. Now is the time to do it. We've got a higher expectations, a higher probability. And what we saw is we said, well, let's just wait for the buying to come in, the selling to come in and go along for that ride for a move up into 17.95 or down into 17.22. What we got is, and that punch, literally the day after, was this really strong punchy move to the upside, which took us into 17.95. Now, this is the bottom end of this range that we saw. We had been trading in a range of 18.34 down into 17.95, 17.90. You can see this with this kind of pink, grey, or pink sort of shaded area. Now we're back in that. This is a really key moment now for the gold market. I've got it on a daily chart, but of course, most people who have probably been in this market would look at gold in a much lower time frame, 15, 30 minutes, 1 hour perhaps. But I'm giving you oversight as to the sort of levels what I'm looking at. Now, we're above the 5-day exponential moving average, which I think is really important. We'd like to see when this comes down, if this is moving up strongly, we like to see a situation where gold comes down, tests the 5-day, and then finds buyers, which we saw back on the 16th. Got a bit of indecision there, and that's obviously going to happen when we go back into this former bid area. Now that is obviously resistance, and the market needs the impetus to try and break through that level there as well. So we're having a bit of wood to chop. The Axeman's coming down and giving it a big old whack. but it feels like the momentum's the upside. I want to trade this from the long side. The bias at the moment in this dynamic is to trade gold in US dollars from the upside. The options market in terms of the break-even levels is giving us about a $27, $28 move up or down. And I think the upside with about a 70% level of confidence is into 1811. And down, if we're down to trade it to the downside, would be 1760. But I feel that this level here around, between 1795 and 1797, if we can get through that level in the coming few days, obviously that 200-day moving average will be an area that the market will look to oscillate. Longer term, the upside is going to be capped over the next week or so around 1833. If we can get a move above there in the next week or two, I think that's going to be a level where we're going to see some mean reversion short positions being put on. I'm not so sure we're going to get there. If you look at the volatility in the market, it does suggest that's a bit of a stretch over the next week, unless we see a big change in the dynamics. But it feels like, given everything we're seeing in the structure, we're making higher lows, the 5 days moving up, that we could probably move into this form of range. If we can squeeze through there, 1811 would be my target on that situation. Obviously, if price can close back below the 5-day exponential moving average, I think we probably trade back down into 1760, 1759, maybe as low as that levels. But for now, the bias is for higher, and we chew through some of these offers into 1795. We looked at Aussie dollar gold just a minute ago. Well, have a look at this chart that we've been seeing. It's been explosive. It's been very, very powerful indeed. You can see here that gold in Aussie dollar terms, Aussie dollar being the weakest currency over the last 5 days. So you've got gold moving up. It's been given that extra kicker by a weaker Australian dollar. Now, everything in Australia is looking pretty miserable at the moment. Obviously, growth in the third quarter is going to be probably contracting about 4%. There's concerns globally about global growth. Commodity prices are seeing some vulnerabilities. The best way to express that, of course, is in short Aussie dollar positions. It's not just around the domestic factors with the lockdowns, but China's slowing down. We saw the credit numbers recently. You express that by being short copper. You express that by being short iron ore. Both of those factors are working quite well. Of course, the Australian dollar is pretty weak. Now what we're seeing after this 5-day move is we're back into this former high. We've got these big pin bar reversals playing through on these days, and that led to a decline. Have we got it again on this candle here? Now, if we flip it over to the FX, to the Aussie dollar chart, you can see that we had this big move down, and that obviously gave some real tailwinds to XAUUD. But now we saw a lower low coming through. The buyers have stepped back in. It feels like this could probably squeeze in Aussie dollar back into these kind of areas around 72.90. As a result of that, I think we'll probably look to the base case at the moment. Of course, we'll watch to see how price reacts. Is that we'll probably look to have a bit of a short covering rally coming back into these areas where people will look to fade the move back down again. What does that mean for Aussie dollar gold? Well, let's go back to that chart that I just showed you just then. In that scenario, we'll probably get a situation where gold will probably continue to fall back down. 5 days moving up quite nicely, so I still like it in that regard. But if the Aussie dollar price is moving back up, as we saw that short covering, then the Aussie dollar gold price is going to face headwinds. If we see that Aussie dollar price come back down, then that will probably lead us back into this former high, and that's where things get really interesting in Aussie dollar gold. If we can get back into this area. And see how price reacts. If we can squeeze through there after a bit of a pullback, let's draw some lines. If we can get back into this area again, things get pretty real. It's going to get pretty spicy. This is going to come firmly on the radar. A break of this level, though, this is when we start talking about momentum. This is when we start talking about trend. I'm not saying it's definitely going to happen. This is why it can be better to react than prophesize. But I think that's going to be a really interesting trade. I feel like this pin bar probably has some downside risks in the short term in time, but what we saw in the Aussie dollar. Let's have a look at the yen. I put out a piece to clients the other day about how much I like the Japanese yen in this environment of a global slowdown. And there's so much attractions about the Japanese yen at the moment. Both the leverage community, both the asset managers are running this massive short position. Sentiment in the Japanese yen, if you look at the DSI on Japanese yen, is absolutely shot to pieces. And if we were to see a situation where we see high volatility in the S&P, if global equities start to make a bit of a move down. At the moment, there's a bit of a rotation into defensive areas of the market, but if that defensive bid comes out and equities go down, the VIX climbs back above 20%, then the Japanese yen is going to be the currency du jour. In that situation, I probably wouldn't want to be long gold in Japanese yen. I'd probably be wanting to be long gold in Aussie dollar terms again, as I say, being that global proxy of growth. But we can see that gold price in Japanese yen, and the yen has been strong, is again having this kind of stealth creep higher. The 5 days just crossed across the 200-day moving average. So again, it feels like there's probably some upside in gold in Japanese yen terms, but how much is there is yet to be seen. Okay, there's been a trade that we've looked at which has really struggled over the last 5 days. And moving away from gold, I want to have a look at palladium. We're staying in the precious metals complex. Platinum, palladium, they don't tend to have bigger moves than what we see in XAUUSD. But you can see after this period of consolidation that we've been seeing really, playing through. You can see that the buyers and the sellers gave up. We saw this big explosive move to the downside in palladium. We're seeing a bit of short covering coming through, but I think this will probably offer levels in which to reapply shorts in that situation. So we're just looking to see how far up this the bar on yesterday's bar this can push up. If it goes above 75%, my view of a short covering rally is probably overdone, and we'll probably actually maybe even look to revisit these highs. But what we tend to like to see is around sort of 50% of this candle, the sellers start to come back in, and then we can move and roll over. We'll take the time frame down into a lower time frame and trade it accordingly to that situation. Let's have a quick look at the US dollar. So I think this is really interesting. Again, coming back to our dollar call at the moment, we're back at these highs. Have a look at this. This is such a pivotal moment. We've got the dollar index, which of course, as we know, is 57% weighted towards euro dollar. I could have pulled a euro dollar chart up, which I probably will do. But again, if this breaks through here, if it breaks through these highs, it's going to reinforce the idea of this kind of dollar strength, perhaps commodity weakness. It feeds through into to that sort of selling of strength in the Aussie dollar, which again feeds through into my gold in Aussie dollar terms call. But I think if we get a break and a close and a hold, the dollar can build up into this situation. Now, going back into the Bloomberg charts, one of the things we are looking at is the level of rates pricing that's coming into the market. At the moment, the dollar is rallying not because of high rate expectations, but we're starting to see a more defensive structure, as I say, coming through to the global economy. China's slowing down. They need to stimulate. The US, we've seen a terrible University of Michigan confidence number the other day. Retail sales last night were poor, down 1.1%. The market at the same time in this kind of period of slowdown is seeing a flatter yield curve, less liquidity coming through the market. Global liquidity is running around 13% year on year. It's come down from a high of around 38% year on year growth. But what's more important to me is not when the Fed are going to look to taper, but what's happening in interest rate markets. If you can here look at Fed fund futures, we can see about 66 basis points of hikes being priced in by 2023, end of 23. Going into 24, you can see about 90 basis points. We work in increments of 25 basis points. So effectively, if you divide that by 25, you can see how many rate hikes are being priced in. But in an environment where we've got slightly slower growth, I mean, there's things that look really good at the moment. Services look really good, especially in the US. The labour markets around the world are improving. And we've got a non-farm payrolls number next week, which will probably see the consensus around 800,000. And that should solidify a tapering. But a slowdown in China, certain parts of the US economy, consumer confidence is lower amid a tapering situation, flatter curves. To me, that's a bit of a toxic risk for markets. And I think if we see bond markets go bid, yields falling lower, that could continue to be very good for the gold market. The question again, which currency do we want to be long in that environment? I've got a question here. Will the Japanese yen be weaker or stronger compared to the euro or the pound? That's a great question. Now, there's a lot going right. So I'll go back to this point. We've got a lot right going in the global economy at the moment. Things are improving. The COVID trends have caused some concern that the reopening trade is not going to be as quick as what people had been anticipating. Certainly in the US, China's got some issues going through, and let's not forget that China has a Winter Olympics coming through in February of next year. Now that's important because they've already told, or the biggest steel producing region in China, I think they're about 8% of global steel production, have said that they're going to cut back on steel production, which of course is having a big impact on the appetite to import iron ore and other such goods. And China will slow down in some capacities as they clean up the skies ahead of that. Now that's obviously impacting the Australian dollar, which is why I look to sell rallies in the Australian dollar, not just what's happening in lockdowns in New South Wales and Victoria as well. But I think in an environment of slower growth, we choose which weapons we want to deploy. The good thing about the euro is it's a funding currency. In times when we see higher volatility in markets, the funding currencies tend to go bid. People look to the safety of funding currencies. The preference is always the Japanese yen because they're running a current account surplus of about 3.3%. They also like the Swiss franc and the US dollar as well. But the Japanese yen is the Mac Daddy of safe haven flows. The euro has some issues. Obviously, we know about those. But I quite like the pound. We saw a strong employment number yesterday. The market's expecting rates to go up in late 2022. We like the pound because there is a central bank there which is talking not just about tapering and when to taper, but actually giving us a timeline and definition for actually selling its bond purchases, a factor we know as quantitative tightening. So the pound has been fairly strong. One of the best ways to play the pound in that situation has been sterling against the Australian dollar. Although, as you can see here, we're going to have a pin bar reversal, which needs to be watched. Tomorrow's candle, if it was to finish there, and if we saw a lower low playing through, that could be a big reversal sign as well. But if we do get a break of 189.50, I think that can continue, and I'll be looking to go long in that situation. And again, how does that play into gold priced in pound terms? I'm not sure if I've got the chart up here at the moment. Well, you can see another strong move up. I mean, the pound's been okay. It's not been one of the best performers over the last 5 days. But as you can see, there's been another strong move. So it just feels, when we're looking at gold and whether it's rallying, we look at is it rallying in every currency? And that gives you that real feel-good factor. Is it selling off in every currency? That's when you know it's a strong move. And, of course, that's what we've been looking for as well. So I quite like the pound longer term. How would I play it? I mean, at the moment, I think any kind of weakness in sterling Aussie probably would give me a buying opportunity, although I like to buy strength in that situation as well. Let's flip back to what we're seeing in terms of positioning. I was really interested last week after the CFTC, after the big Monday liquidation that we saw from leveraged accounts, whether or not we were going to see that reverberating in a big liquidation in the futures position. And as you can see here, this is the weekly CFTC managed money in gold. This sort of combines everyone who's the big players in the futures market of gold futures. And you can see here that there was a big drawdown in terms of those futures positions. We saw that net long position going from 107,000 contracts down to 51,000. So obviously it collapsed. This is of last Tuesday, so obviously one suspects that position has been flushed out. But we're still long. But obviously we're pretty neutral in terms of position. But you can see after that Monday liquidation, the futures position draw down very, very quickly indeed. We also have a look at the options market as semantics around gold. It just really tells me everything that I need to know. We look at risk reversals here, and I've basically on the top one, you can see the orange line here, 1 week risk reversals. This is to me the best semantics guide that you can get on the gold market or pretty much any asset that has an options market attached to it. And what you can see here is using 1 week options, we're looking at the 1 week call volatility and minusing 1 week put volatility. In layman's terms, the more negative this number, the greater the market is anticipating movement to the downside relative to the movement to the upside. And you can see here back in March at negative 3.9 vols, the market was saying, well, if we're going to get a move, it's going to be significantly more powerful and pronounced to the downside than if we were to get it to the upside. I like to look at this as a contrarian indicator in some capacities. Is there too much negative or too much positive news being priced in? So over the coming week, over using options that are expiring over the coming week, we can see that the market is, the put volatility is trading at a premium to call volatility of about 0.31 of a vol. So it's pretty neutral, to be honest. I mean, earlier in the week we were down at these levels, negative 1.5, which was really to me that there's a lot of bad news still being priced in, but it's not extreme. Now it's come back to a more neutral situation. The same is in 1 month options, where we can see that the premium is for put volatility over call volatility. It's come back a little bit, but we're not at levels where, even though we've seen a little bit of rally back into 1795, that I think that the market's saying to themselves, we're overdone here. The market is still somewhat net biased towards a bigger move to the downside than they are to the upside. So again, in terms of semantics, positioning is fairly neutral, slightly long. In terms of the options market, we can see we've come back off these lows, but we're still slightly skewed to a bigger move to the downside than the upside as well. So I think that's really important. In terms of the next couple of weeks, I'm just going to go back to the charts and just sort of go back into where we've been. Look at crypto. Let's go back to the gold chart there. We are at make or break. Do we break back into this former range and then perhaps trade into 1811, where I'd probably look to be capping the move about a 70% level of probability? But we need to break through these levels. In the next week or two, put these dates on your radar. The 1st of September, the consumer confidence numbers coming out of the US. The University of Michigan numbers were a disaster. There is about an 80% correlation over the last 20 years between the University of Michigan consumer confidence and the CB number. So one suspects we're going to see a collapse on that. On the 2nd of September, we've got the ISM manufacturing numbers. The market's expecting that to improve a little bit. And then on the 3rd of September, we have got the next payrolls number. Going back a little bit before that, on the 28th next week, we've got the Jackson Hole Symposium, where they may open the door. So there's plenty of event risks over the next week or two for the US dollar. Of course, we're going to look at the bond market very closely. If yields continue to head a little bit lower, gold prices will break through 1795 and back into that former range. Obviously, if we see yields moving higher, that could strengthen the dollar quite sharply, and that could put gold in the downside as well. The preference, as we've seen, is in Aussie dollar gold. We're waiting for a little bit of weakness or I'm certainly looking to buy that dip in that situation there as we get a bit of a short covering rally playing through. All the comments I've said today are my own comments. They're not a reflection of my employer, Pepperstone. They should be considered personal advice, and please do not take should be considered general advice. Please do not take them as personal advice in any capacity. But that's the way that I'm seeing the world at the moment. Lots of volatility potentially to come, as we've seen the ranges have been creeping down. So it's been a bit of a stealth climb. Plenty of event risk to come through. I think the global economy is at a really interesting point. There's a kind of eerie calm and a concern that's come over the global markets. And perhaps that could lead to higher volatility, which could really keep the gold market coming alive. So looking for markets, the gold price in US dollar terms, to get back into this 17.95, potentially break and hold into this new range. Gold in Aussie dollar terms, another really interesting one to watch there as well. Can that bull trend continue indeed? If you found yourself liking this video today, hit the like button. It'd be really, really liked if you could do that. Obviously, really help the channel and help this video going forward. If you want to subscribe, then that's fantastic as well. If you've got any questions around this, do leave them in the question box. Be happy to answer those. Anything about gold, anything about currencies, or any of the macro stuff that we've talked about there. I hope you've enjoyed the video. Thank you for watching. And if you've got any more questions, leave them here. It should be an exciting time in gold going forward. Trade it with Pepperstone. Thanks, guys.